Imagine walking through a busy financial office where every transaction is recorded with precision and every error can cost millions. Welcome to the world of journal entries in financial accounting, a realm where every debit meets a corresponding credit and accuracy is the cornerstone of success. Today, we embark on an instructional journey that unravels the principles of double-entry bookkeeping, the art of processing journal entries, and the critical adjustments that ensure true and fair financial reporting. Our story begins centuries ago with the pioneering work of Luca Pacioli, widely recognized as the father of finance. His revolutionary concept of double-entry bookkeeping laid the foundation for modern record-keeping. In this system, every entry is an assurance that for every debit, there is a matching credit, much like maintaining balance in our lives. But why are journal entries so important? They are the diary of a business's daily transactions, the guiding light that helps avoid data loss, maintain a sequence in recording transactions, and detect errors before they spiral out of control. In our journey today, we will reveal how journal entries are prepared, how they transition from drafts to published records, and how they maintain the integrity of financial information. Act 1: The fundamentals and formulation of journal entries. At the heart of every financial transaction lies the journal entry, a written record that captures the essence of business activities in real time. An organization's financial diary is more than a mere list. It is a meticulously timed sequence that not only forecasts and plans for the future, but also safeguards against discrepancies and errors. Imagine a bustling business where every sale, purchase, or adjustment is recorded as it occurs, ensuring that no financial detail slips through the cracks. The process begins with the creation of journal entries. In the earliest stage, financial transactions are gathered from source documents. These source documents, factures, receipts, and invoices, serve as the raw material for preparing draft journal entries. This is where the importance of precision shines. A journal entry is more than a number. It is a narrative that highlights the nature of a transaction. For instance, when a business records a sale, the entry not only reflects the increase in cash, but also documents the decrease in inventory. The dual nature of every transaction stems from the fundamental principle of double-entry bookkeeping. For every debit, there exists an equal credit, ensuring that the accounting equation, assets equals liabilities plus owner's equity, remains in perfect balance. Once the initial entry is drafted, the next step is modification. Here, accountants review and edit the entries to ensure error-free record keeping. This process is essential. An unpolished journal entry can lead to larger discrepancies that distort the financial picture of an organization. Through careful review and refinement, every journal entry is prepared for its eventual publication into the accounting system. And once published, these entries act as the backbone of financial statements, serving auditors and decision-makers in evaluating business performance. Act 2: Special entries, error resolution, and the battle against misconceptions. With the basics established, we move to advanced territory, a world of special journal entries that address unusual transactions and the inevitable human errors that occur along the way. Think of special entries as the editing process in a compelling novel. They are the critical adjustments that help align the story of financial transactions with reality. Special journal entries come into play when handling events such as capital contributions, bad debts, discounts, and the correction of errors. Picture a business receiving a capital infusion from its owners, where the infusion is recorded to sustain operations and spur growth. In these entries, special attention is given to whether the capital is provided as an equity injection or as a debt, each with different implications for the financial structure of the organization. Then we confront the challenge of bad debts, those frustrating amounts owed that may never be collected. A business, much like any individual, faces situations where, despite great effort, some debts become irretrievable. There are two main approaches in managing these debts. The direct write-off method is straightforward, where debts become uncollectible after extensive collection attempts and are removed from the books as an expense. On the other hand, the allowance method anticipates potential defaults by ensuring that a provision is set aside to cover future bad debts. Each method plays a pivotal role in financial clarity, ensuring that the reported expenses align closely with reality. Through detailed examples, such as recording a doubtful debt of $15,000, we see how these adjustments affect both the income statement and the balance sheet, illustrating the seamless interplay between theory and practice. Even more intriguing is the way businesses handle discounts. When a customer receives a discount, it is recorded as a discount received, boosting their bottom line. Conversely, when a seller offers a discount, it is logged as a discount allowed, an expense that reduces profits. These transactions, though seemingly simple, contribute to the overall narrative of financial ethics and accuracy. Yet, perhaps the most critical element is error identification and correction. Mistakes can happen at any stage of the journal entry process. To address these, organizations implement follow-up entries, often transferring discrepancies to a suspense account. This method not only rectifies errors, but also preserves the integrity of the financial statement. The process of transferring incorrect amounts reinforces the belief that every mistake is an opportunity to refine and improve, ensuring that what is showcased in the financial statements is both true and fair. Act 3: Adjustments, Systems, and the Road Ahead. As we progress, it is essential to understand that accounting is not static. Like any dynamic field, it evolves with the need for accuracy and transparency. Balance day adjustments serve as a linchpin to this evolution, ensuring that all revenues and expenses are correctly recorded at the end of an accounting period. Imagine a business closing its books at year-end. It must reconcile what was received with what was earned, and what expenses were paid with what was incurred. These adjustments are not mere corrections. They are refined recalibrations that bridge the gap between cash receipts and the economic reality of revenue earned and expenses incurred. The journey encapsulates more than just the day-to-day recording of transactions. It extends to complex accounting systems, such as cash-based and accrual-based accounting. Under cash-based accounting, transactions are recorded only when cash physically moves. While this method can simplify record-keeping for small businesses, it fails to represent the full spectrum of a company's financial health. Accrual-based accounting, however, stands as a more robust system. It matches revenues with the expenses incurred to generate them, regardless of when money is exchanged. Through carefully constructed examples, we see how even a large-scale project, like a contract valued at $8,000, reflects differing profit patterns in these two systems. Additionally, the narrative explores the subtleties of non-operating revenue and stock accounting. Non-operating revenues arising from activities outside the core business operations must be clearly distinguished to provide stakeholders a balanced view of operational performance. Stock accounting, with its year-end evaluations, reminds us that the assets on hand today may no longer hold the same value tomorrow. Underlying all these procedures are the undisputed guidelines of industry standards and conventions. The Australian accounting standards, for instance, play a crucial role in harmonizing reporting practices, ensuring that financial statements are consistent, transparent, and comparable across different periods and entities. Naming conventions, too, are vital. They allow every financial document, from trial balances to income statements, to be dated and identified with precision. Throughout this instructive journey, we are reminded of the core principles that underpin accounting. The going concern principle reassures us that a business is set to continue functioning, while the matching principle ensures that every revenue figure is paired with its corresponding expense, laying bare the true profit of an enterprise. As we draw our journey to a close, consider the vivid images of meticulously maintained journals, the rigorous processes of verifying and correcting entries, and the dynamic adjustments that breathe life into financial statements. Every transaction recorded in a journal is a testament to the precision and discipline required in financial accounting. There is an underlying story of diligence, of numerous checks and balances that allow both budding accountants and seasoned professionals to navigate the intricate world of finance with confidence. In summary, we have traversed the timeline from the historical origins of double-entry bookkeeping to modern challenges in recording and adjusting financial data. We witnessed the creation and modification of journal entries, delved into special entries that address modern financial challenges, and learned the vital differences between cash-based and accrual-based accounting. Along the way, we uncovered the significance of industry standards and the enduring principles that ensure every financial statement represents a true and fair view of an organization's economic reality. As you now move forward, armed with the knowledge of journal entries, double entry methods, special adjustments, and systematic error corrections, remember that mastery in accounting is not solely about numbers. It is about the integrity behind every financial decision. Embrace the discipline of detailed record keeping and let every entry serve as both a lesson and a commitment to financial precision. Visit AASB website now